Welcome back, best ever listeners, to the Horizon podcast. This week, I'm going to focus on some of the government policy that is shaping the commercial real estate outlook. I'm talking about tariffs, immigration, the government shutdown. Now, I need to point out that I am not taking sides here, but I'm sharing my thoughts on how these national policies could shape the commercial real estate investment market as we go forward. So I'm Chang, and I've been active in real estate investing most of my life. And since 2007, I've had the opportunity to lead the research and advisory services team at Marcus & Millichap, the leading commercial real estate brokerage company. Now, I must mention, as I do each week, that I am doing this podcast independently, and what I say on this show doesn't reflect the opinions or positions of Marcus & Millichap. So, all that being said, the top news of the week is the government shutdown. Now, this will come out on Sunday, and who knows? They might strike a deal in the next day or so, and put this to bed, in which case the government shutdown is done. But I'm of the opinion this may be lasting for a while. So I am still going to cast a wider net and talk to issues other than the government shutdown and kind of the broader government policy and how I believe these things could impact commercial real estate over the next several years. I think this is a multi-year issue. So let me start in with the issue that is generally causing the most disruption, in my opinion, and that's tariffs. Right now we have 18% net effective tariffs. And as I've mentioned before, basically, if you take all of the stuff we imported and give it a weighted, average, basis, and then multiply those individual pieces by the tariffs, then you come to measure the net effective tariffs. Right now, they're about 18%. But we have some new tariffs, that have just come out. We have 100% tariff on pharmaceuticals, 30% tariff on upholstered furniture, 50% tariff on kitchen cabinets and bathroom vanities. And in August, I think the 35% tariff on Canadian softwood lumber was put in place. As you may recall, Canadian softwood lumber is about 25% of the wood used in construction for single family and multifamily garden style housing. So, a lot of the conversation has been surrounding the impact of tariffs on inflation and how that should affect the Fed rates. Several people say, hey, you can look through these. These are, transitory and they're one and done, and we can look through that and not shape our interest rate policy based on the inflationary impact of tariffs. Now, personally, I look at that and go, yeah, okay, if if in April we said, okay, we're going to put 10% tariffs on everybody, we're done. 15%. It doesn't matter what the number is. If we were one and done, then yeah, this could probably be transitory. It's a one-time thing. We'll see a bump in the cost and then the inflation goes away. But that's not what we're seeing. Like I said, we just put a bunch of more new tariffs in there, just in the last week or so. So this is not a one and done. So you can't look at this as a transitory inflationary item if we keep moving the numbers around and keep recalibrating these things. We still have some tariff conversations to go with Canada and Mexico and numerous other countries around the world. So this is not a done deal. And as a result, the inflationary impact of the tariffs will carry through and will not be transitory. It will be a ongoing challenge going forward. Now, these new tariffs on cabinets, bathroom vanities, and lumber are going to make apartment development specifically more expensive. Value-add strategies get more expensive. The good news is on value add, if you're just doing a few units, they did increase the section 179. I think it is, write-off on the taxes, so you can expense that. But nonetheless, the price went up and the cost went up, even if you can expense those items rather than depreciating them. So tariffs are effectively a tax. Now, who pays it is irrelevant. It's still a tax, right? So far, estimates place the impact of the tariffs have not been significant. We haven't seen a huge run up in inflation, although inflation is going up a little bit at a time every month. It hasn't been the spike or the jump that many expected, myself included. And the big part of that was, first of all, a lot of the companies front loaded their inventories. They got a lot of shipments in before the tariffs took place. And the second thing is that companies have been absorbing a big portion of those tariffs so far. Estimated by Goldman Sachs was about 65% of the tariffs cost increases have been eaten by companies, but the companies are also saying they can't afford to do that forever, and they're going to start passing those through. So that is going to put upward pressure on inflation, especially as those costs get passed through to consumers. I also want to point out that they're having an outsized impact on small businesses, which are in a weaker position to absorb those expenses, who haven't been able to front load as much inventory and so on. So big corporations, maybe like a Home Depot, is going to be able to absorb those costs for a while and negotiate, lower costs from their manufacturers, perhaps. But the smaller companies are not going to have those advantages. Now, the next policy I want to talk about, and I'm going to pull this all together at the end. So I'm not done with tariffs yet, but I want to jump over to the next policy, which is immigration and how that is affecting the outlook for the economy. Now, we have to remember, historically, the U.S. has imported labor, right? Think back to Ellis Island and all of the people from Europe who came to the United States, Italy, Ireland, and countries all across Europe. You look at Asia, we've had imports from Asia. We've had imported labor from Latin American companies. We've imported labor from Africa, all over the globe. People have come to the United States for opportunity, but they also come and really backfill labor shortages. And so this has fueled economic growth in the United States for hundreds of years, right? We are a nation of immigrants. And so changing our position on immigration, again, right, wrong, or indifferent, but it will weigh on our labor supply, right? And it also will weigh on our total population, right? So the Census Bureau estimates that under a net zero immigration policy, where we effectively have no new immigration, or we're deporting as many as are immigrating to the U.S., however you want to calculate that. But basically, the U.S. population will begin shrinking in 10 years under that model. And we see this in how we're handling deportations, the additional restrictions on H-1B visas, the restraints on international students coming to the United States, many of whom historically have stayed in the U.S. to fill jobs in the country. So all of these policies lean toward a net zero immigration, and our birth and death rates are about flat. And so without immigration, our labor pool is not filled. We have an aging population with the baby boomers. The millennials are in their 30s and 40s. And as you look down the population age profiles, the number of younger people gets smaller and smaller as you look past that. So we have that millennial generation pop, which is going to carry us for a few years. But ultimately, our economic growth will face a lot of pressure as the population flattens out and ultimately shrinks. So The other thing, and I'm just thinking about this now, is the impact it's going to have on Social Security, Medicare, Medicaid, as you have a shrinking population of working adults supporting a larger and larger pool of retirees. So this could be an issue. This could be a problem. And I also want to point out that the immigration policies, because you're shrinking the labor pool, or at least flattening it out, it stalls out growth, but it also creates inflation as labor shortages spur rising labor costs. Currently, the sectors most dependent on foreign-born labor include agriculture. 43.5% of the employment in that sector is non-native people in the United States. Construction, 35.6%, food prep and food service, 25.4% of the workers, and healthcare, 23.7% of the workers. So we're already seeing a little bit of a pushback and uproar in some of the agriculture states where they're having a hard time going through harvest because they don't have enough people to help them to harvest the products from this season. This gets worse as we go forward. So, the labor shortage ultimately will play through if we don't have immigration. And, AI can do a lot of things, but it's right at this point today, it's not picking corn. All right. It's not harvesting fruits and vegetables. It's not preparing food. It's not providing healthcare to speak of. It's helping with diagnostic, it's increasing throughput, but it's not building houses. So these are all areas where you're going to see increased costs, and that plays through to consumers. And so these policies tend to be inflationary. It's going to take time to see the full impact. This is a multi-year change, right? Again, we're in uncharted waters in terms of these tariffs and these labor policies. But I suspect it's going to take multiple years to see the full impact of these changes on the economy and on the commercial real estate market. Now, these inflation pressures are out there, and the Fed is wary of this, but the Fed is also under a lot of pressure to cut rates. Now, I find it ironic. One of the key things that the Fed is watching out for, the only thing that could stop rate cuts really, honestly, is if we see a spike in inflation. Inflation is tracked by the Bureau of Labor Statistics, which is now closed because of the government shutdown, which means that the inflation report for September may be delayed, or it might have, it might not come out ahead of the Fed meeting. In addition, when you look forward beyond that, if the government shutdown is extended, or if President Trump follows through on his threats to lay off a lot of the furloughed employees, this could have significant implications for measuring not just inflation going forward. We might not have an inflation report for October, which would come out in November ahead of the December Fed meeting. But it also impacts our measurement of jobs and employment in the United States. So again, we have some lack of data as a byproduct of the government shutdown, which basically kind of blinds us in one eye when we're trying to figure out what's ahead and make business decisions. Now, at this point, the probability of the Fed cutting rates in October is basically 100%, 99 point something percent. And the odds of a rate cut in December, another 25 basis points, it's like 93%. So both of them north of 90%. They're pretty much highly likely and baked into the current interest rate climate. But will that be the right move? We might not know, because we might not have the appropriate data to determine whether that's the right move. So we may be, just staying on course without any information to help us course correct. But a byproduct of all of this shortage of information and all of these other forces, the tariffs, the immigration policy, is increased uncertainty, and uncertainty spurs caution. And that weighs on the employment market. Job openings are tapering. Companies are slowing their hiring processes. They're not laying off people because they don't want to lose good people because they don't know what's around the next corner. So basically, a lot of companies are moving into a holding pattern. And as a result, that will cause a slowdown in the labor market and hiring. So we're already seeing the numbers taper. We're not getting the September jobs report on time, forcing us to rely on other data sources. ADP came out with their report for September, and they said we lost jobs that month. That does not factor in government positions, but I think government hiring is pretty much flat or negative at this point. So we may be going into a pretty severe employment slowdown, possibly shifting into net loss of jobs. We did see that in June, according to the most recent data from the BLS. Again, ADP has a couple of months with net negative hiring so far this year. So, as the labor market grinds down, it doesn't take much to convince business executives that we may be going into a recession. And as soon as they believe that, then hiring stalls out altogether and we may move into a full-blown recession. The government shutdown, particularly if it includes layoffs of the furloughed personnel, that could quite possibly be the straw that breaks the camel's back here. And so there's a real possibility that this shutdown that we're going through right now, it ultimately pushes us into a recession. It's possible. I'm not saying it will. This could be done. This could be done before this recording even hits the streets. So I don't know. I'm just saying that it does pose an additional risk. Now, this brings up the next thing, right? So if tariffs and immigration policy restrain growth and they increase inflation and uncertainty, combined with, other forces slow down the employment market, we could push into a stagflation model. Again, I don't think it's as severe as what we were in the 70s and 80s, but it's still not a good thing. So we have higher inflation, we have some sort of economic slowdown or recession, and we get that stagflation. We don't have good commercial real estate data going back to the 70s and 80s. We didn't have a CoStar, we didn't have RealPage, we didn't have any of these data companies that emerged in the late 90s and early 2000s in the US. To meet the needs of our data consumption and our decision making. They weren't around in the 70s and 80s, and we didn't have computers really to speak of in the 70s and 80s. So there's very little historical data of value, at least on a macro basis, of the last stagflation cycle. So we can only speculate what the impact will be. Kind of take a recession again, we don't even have very good recession history to base off of. 2001-02 is the only recession that I think would be relevant. It's not, this wouldn't be like the pandemic. This wouldn't be like the global financial crisis, hopefully. So 01-02 is the only recession we have to work with where we have real solid data. There is some data that goes back further, but it's less reliable. So anyway, it's really hard to say where things will go under a stagflation, but I would venture a guess that it's not good, right? I think absorption slows down. I think there are some markets that are going to be more impacted than others. But before I go there, or before I kind of drill, go down that rabbit hole. I got to reiterate, it's not all bad news, right? These are risks that we should be thinking about. These are challenges that may be ahead, and every investor should be contemplating, okay, exactly how would this affect me? And again, if you're investing in Chicago, you have a different perspective than if you're investing in Dallas. And if you're in DC and this goes, the government shutdown translates to furloughs, that could be a higher risk market, right? Northern Virginia, same story. There are markets in California which have more reliance on government workers. So each market is going to be impacted differently, but not everything is bad news, right? So household balance sheets are really strong. Honestly, you look at the savings that's built up, it's almost at a record high. On an inflation adjusted basis, this isn't just, inflation lifting the numbers. This is inflation adjusted. Household balance sheets, and savings, including money market mutual funds, are almost at a record level. They're just shy of where they were when everybody was getting, the stimulus checks and when stores were all closed. So, elevated savings. The stock market is still up. I don't know why sometimes, but it is. And the debt to income ratios are still very low. So if you take total household incomes and you assess it against the debt ratios on a macro basis are not looking bad. In fact, they're looking quite good. They're very low by historical standard in general. Now, that doesn't mean there aren't segments of the population that have really high debt to income ratios. And there are some portions that are very low, right? So wealthier households are in a much better position than low income households, obviously. And that's baked into the math. And I'm using an average. It's kind of like saying, what's the average temperature in America today? Well, some places are hot, some places are cold, but on average, it's whatever, 70 degrees. So it's useful to a degree, but you also have to navigate around the intricacies of your portfolio and the clientele it caters to. Right? If your commercial real estate is focused on top tier class A, you're probably face less risk because the household balance sheets in that segment tend to be stronger as opposed to class C or class D, especially if it's in an immigration impacted area, or a heavy immigration area. We're starting to see more and more stories of neighborhoods vacating, some in Florida, some in LA, where there was a heavy immigrant population and they're moving out. So the policies could have different effects in different areas. So that's important. A lot of times I speak in generality because I'm using macro level data and I'm speaking to an audience across the country, across property types. But again, you got to do the math and drill down into the local market. But household balance sheets are strong. The ISM indices, the Institute of Supply Chain Management indexes, which measure the outlook from different types of companies, they're still holding up pretty well. Manufacturing index is at 49. 50 is break even. Anything under 50 is quote unquote recessionary. Anything above 50 is growth. Manufacturing is at 49, and it's a degree of magnitude, right? So 49 is almost break even. Services index is at 52, suggesting we are still in a growth mode from a services industry perspective. So, that's still holding up and doing well. And we still have, good capital investment in infrastructure. So we're still seeing companies invest into growth. But the GDP data may come to a standstill, which is where you get that capital investment number, as the Bureau of Economic Analysis, is closed because the government shut down. So, that's where we see a lot of those pieces. And there's the challenges, and opportunities that are out there as a byproduct. Now, I do want to address the government closure itself. Quite frankly, it's generally not considered to be a significant economic event. All right. Most of the losses driven by the shutdown are recovered after the shutdown ends. So people go on furlough, they don't get paid, but after they come back, there's back wages that are all paid up for the time that they were furloughed. And so the spending slows down and then it picks up again. And nonetheless, they estimate, and by they, I think it was Goldman Sachs and Ernst & Young or some other accounting firm, they estimate that the government shutdown shaves 15 to 20 basis points off of the GDP numbers. Each week the government is closed. So not completely insignificant, but if it's a short government shutdown, it's a hiccup, right? We get past it, we move on. If it's a long government shutdown, it has more impact because the net losses are bigger and the startup process to get moving again is longer. The recovery process is longer, and we miss a lot of data collection that would have normally been happening during that time. And as an analyst, a real estate analyst, that is probably the thing that concerns me the most, is that we're going to have holes in our data that would inform future decisions. Now, if the furlough turns into layoffs, a lot of that bounce back that we would normally see after a government shutdown is dissipated because those people don't go back to their job. They don't get back pay. And so that could have a much greater economic consequence for the U.S. economy. And again, the longer this runs, the worse things get. The longer it goes, the more it impacts confidence levels and decision making and uncertainty. So again, we're in a place where the policies are raising uncertainty and caution, which slow down business growth, as well as household formation, as well as spending, as well as the performance of commercial real estate. So the risks rise over time. Now, I'm going to take the last few minutes here to focus on the longer term perspective, the outlook, and I'm going to focus the whole thing on real estate. So, in general, the policies that are in place could weigh on retail and industrial performance. I'm talking about reduced imports because of tariffs, reduced consumption if we go into a recession or stagflation. And again, just the uncertainty around this, causing companies to reduce their inventories maybe a little bit, and be more cautious in their retail, especially as prices rise and you see more inflation. And if that impacts consumption, retail and industrial properties could be affected over time. Again, this could take years to truly manifest. And I think we see little teeny movements over a prolonged period. Hospitality has already been impacted, and it will be impacted even more. You have international relations that are weighing on tourism to the United States. The shutdown has closed a lot of the national parks, which are tourist destinations, and the hotels around there are going to be impacted. Slowing economy, stagflation, reduces disposable income, which would in turn slow demand for hospitality. And then on top of that, you have rising labor costs due to labor shortages. So impact on the hospitality sector could be significant. Again, over time, we could see some less significant impact on medical office and seniors housing, largely through labor shortages and rising labor costs. Office properties in general probably see very little impact overall from the policies. At least I haven't come up with anything yet. So office actually could be positively influenced by a weakening economy as unemployment rises, because a lot of companies have been itching to get their workers back into the office, and this may be the opportunity to do that. Multifamily, again, I mentioned this earlier, you could have some impact in areas with dense immigrant population. If we go into a recession or a stagflation cycle, I was looking at some historical trends, and interestingly, this kind of goes contrary to what I had perceived or believed in the past. And that is Class C vacancy rates tend to go up more during recessions. Class C apartment properties tend not to perform as well. I mean, the thesis I always lived on was, people always need a place to live, and the cheapest place to live might be the only place that someone can afford. But on the flip side, household formation stalls out, more people double up, and maybe they go into a B apartment instead of a C apartment, and when they get a roommate. So, vacancy rates in Class C have historically gone up during recession cycles. Not sure how it would work in a stagflation, but I think it would probably be somewhat similar. So that's something that's at risk. And again, neighborhoods with a elevated immigrant population may be placed at more risk than areas that are not as densely populated with immigrants. The flip side is construction for all types of commercial real estate is going to continue to slow down. The tariffs are having an impact. They're raising construction costs. Labor is highly dependent. Construction labor is highly dependent on immigrant workforces. I think 35%, give or take, are foreign born. And so as a result, construction labor costs rise, and you start to see some impact there as well. So I believe construction is going to continue to slow down. I've been saying that for a while now. We're starting to see the impact, or we're starting to see that slowdown. And in some markets, we're seeing positive momentum that is exceeding the pace of construction, which is driving vacancy rates down and raising rent growth. So that is definitely a positive over the long term. So net, the impact of all of these policies on commercial real estate, while they impact the macroeconomy and certain segments of commercial real estate, the overall net impact on commercial real estate is marginal. And the areas that are going to be impacted the most can be navigated around with good investment strategy. So in other words, by understanding the pressure that is going to be on the commercial real estate market, the drivers of that pressure, and how specific places, geographies, cities are going to be impacted in different ways, investors have the opportunity to navigate around those pitfalls and get to places where there's less negative drag on the performance of those properties. So this is where you can get tactical and really drill down and find unique opportunities that actually get lift from some of these policies, right? I was talking to one investor who was looking at a multifamily building near a steel factory that is under construction. Steel factories in the United States are going to benefit from the 50% tariff on steel, and therefore that factory has a pretty good outlook. And as a byproduct, that apartment building that is proximate to the steel mill will benefit, right? So you can move around the pitfalls with good strategy and tactics by using information that you have available. So at the end of the day, that's a big piece of why I believe commercial real estate may be the best investment option in this climate, in a period of uncertainty, in a period where we have tariffs, where we have immigration policy change, where we have government shutdown, where we have inflation impact, where we have a lot of protected industries and so on. That creates opportunity. And when you look at its returns relative to, say, the stock market or bonds or other investments, real estate is very well positioned to navigate these types of economic climates. The inflation resistance is generally good, especially for like self-storage and multifamily. And and so on. There are built-in advantages for commercial real estate in a economic cycle like what may be ahead of us. Anyway, that's what I got. I'm going to wrap up there. I'm into this 35 minutes here. So thank you for joining me, best ever listeners, and, best ever watchers. For those of you catching this on YouTube, we're now on YouTube. So if you want to get my visual animation, as I'm talking through this stuff live, watch the video version on YouTube. Anyway. Thank you for joining me. Remember to like, subscribe, hit the thumbs up button, whatever it is. I'm not too into the social media side, so I'm not sure exactly what you need to do there. But give me some positive feedback if you enjoy this, and I will be back next Sunday and every Sunday with the real estate insights to help you understand what's really going on in commercial real estate. I'll see you next week, and as always, keep your eyes on the horizon.